Today, we're diving into the topic of real estate dominance. In both mainland China and Hong Kong, real estate plays a pivotal role in the economy, a phenomenon some describe as real estate dominance. However, this once formidable force is now waning, even fading away. Across both regions, property prices are falling sharply. More critically, real estate developers and companies are struggling, facing the constant threat of bankruptcy or default. Today, we'll explore how this so-called real estate dominance emerged, how it flourished and then declined, and what this shift from prosperity to decline reveals about broader trends. Let me share my conclusion up front. The decline of real estate dominance is not a cause for celebration. It signals not only a shift in the economic cycle but also a profound transformation in society as a whole. Let's begin with the fundamentals. What exactly is real estate dominance? The term originates from a book by Poon Wai-yin, a veteran of Hong Kong's real estate industry, with experience at firms like Sun Hung Kai Properties and Carey Properties. Drawing on her extensive first-hand knowledge, she argues that Hong Kong's real estate dominance stems from collusion between the government and property developers. According to her book, this dominance is rooted in a land monopoly system. The Sino-British Joint Declaration limited Hong Kong's annual land supply to 50 hectares, a policy intended to regulate land availability, but which ultimately set the stage for exorbitant land prices. The Hong Kong government controls land supply, driving up prices, while developers purchase land from the government and inflate property values. This dynamic has made both the government and businesses heavily reliant on land, with land-related revenue forming a significant portion of fiscal income. At its peak, land sales accounted for over 30% of the Hong Kong government's total revenue. Developers, through their close ties with the government, reaped enormous profits and aggressively acquired market assets. The book notes that 6 major real estate families in Hong Kong, the Kwok, Pao, Li Ka-shing, Li Shaoqi, Kwok, and Chung families, at one point controlled over 50% of the market value of listed companies. This concentration of wealth in the hands of developers gave rise to what is termed real estate dominance. This model was later adopted in mainland China, where government land sales and developers' price speculation fueled the largest real estate bubble in history. The book offers a professional and authentic portrayal of the industry's inner workings. However, while the author provides valuable insider observations, her broader perspective is limited, and her analysis lacks a comprehensive framework. As a result, she fails to fully explain the reasons behind the industry's distorted prosperity. The book's primary flaw is its attribution of all issues to land monopoly. It argues that the government's control over land supply enabled the real estate industry to inflate prices, causing property values to soar. This view is widely accepted today, but its origins trace back to Poon Wai-yin's work. Many commentators and public intellectuals, unfamiliar with the book, unknowingly echo its arguments in diluted forms. Criticizing land monopolies and condemning government and capitalist collusion resonates easily with the public. However, I must emphasize that this perspective, which critiques government and capital from the standpoint of the masses, reflects a proletarian or populist worldview. It assumes the people are inherently just, benevolent, and perpetual victims of collusion between officials and businesses. This leads to a simplistic conclusion that the masses are oppressed by real estate dominance, a view that is overly reductive. This perspective fails to hold up for 2 reasons. First, government control over land persists unchanged in 2025, yet property prices in both mainland China and Hong Kong are now plummeting, and many developers face insolvency. Recent data from both regions' property markets clearly illustrates this trend. From January to June this year, real estate development investment in China totaled 4.66 trillion yuan, down 11.2% year-on-year, while residential investment reached 3.57 trillion yuan, down 10.4%. In certain cities and regions, the sales area of commercial properties has dropped by as much as 30%. Over the long term, China's real estate sales area has regressed to 2009 levels as of around 2023, signaling the end of the real estate sales boom. Real estate development growth has been declining for approximately 15 years, falling from a positive 30% in 2010 to a negative 10% in 2024. The disparity between real estate investment growth and fixed asset investment growth continues to widen. In Hong Kong, the property market has deteriorated sharply following the pandemic and the national security law. The Centa-City leading index, which tracks transaction prices, has fallen from a high of 190 points in 2020 to roughly 137 points today. property prices are broadly declining and major developers, burdened by high debt and shrinking profits, are in distress. For instance, New World Development recently faced severe challenges, reporting a loss of nearly 20 billion Hong Kong dollars in its last financial year, the highest in its history. The company's debt-to-asset ratio has exceeded critical thresholds, positioning it as a potential Hong Kong equivalent of Evergrande. New World survived only through extensive borrowing and tens of billions in refinancing, but its long-term outlook remains grim. New World exemplifies the plight of Hong Kong's once dominant real estate giants, now reduced to struggling entities. The monopoly theory alone cannot explain these changes. Both mainland China and Hong Kong remain under land monopoly policies, yet property prices have shifted from rising to falling, and real estate dominance has largely vanished. The monopoly theory is insufficient to account for this phenomenon. Second, real estate dominance is underpinned by a widespread public belief in real estate. While ordinary people in mainland China and Hong Kong criticize real estate dominance, many aspire to amass wealth through property investments. For most, real estate is the preferred investment when funds are available. In other words, the public harbors a deep faith in real estate, resenting wealthy developers while simultaneously dreaming of becoming major landlords or developers themselves. They decry the rich, yet yearn for quick riches. Attributing everything to land monopoly is an oversimplified and incomplete analysis. Ordinary people are not blameless. They are complicit in perpetuating real estate dominance. Those who view the masses as pure and innocent are either misguided or disingenuous. Developers and governments are far from virtuous, but the public's moral standards are equally driven by self-interest. Blaming real estate dominance solely on land monopoly is a superficial and flawed perspective. Instead, we should examine how this dominance arose, how it declined, and what this cycle reveals. From a broader perspective, real estate dominance is a global phenomenon, not unique to China or Hong Kong. In any market economy, high property prices and real estate dominance emerge at a certain stage of development. Their rise and fall are part of the economic cycle. The critical question is not to denounce this dominance but to investigate what follows its collapse and whether a worse scenario might emerge. That is the true issue. The harms of high property prices are evident and need little elaboration. They widen wealth disparities, with property owners experiencing exponential wealth growth, while those without properties see their wealth stagnate. This distorted price structure creates numerous social issues. However, my focus today is to explain the phenomenon of this abnormal price structure, or real estate dominance, and its underlying principles. This is a widespread phenomenon, occurring in many countries and representing an inevitable phase of economic development. To understand this, consider a 2024 Sociology Yearbook article titled A Sociology of Real Estate, Polanyi, Du Bois, and the Relational Study of Commodified Land in a Climate-Changed Future. It argues that real estate is not merely an economic issue, but carries broad social implications, warranting sociological analysis. Citing political economist Karl Polanyi, the article views real estate as a unique commodity, historically tied to land, which is the source of human notions of home and tradition. Sociologically, real estate represents not only an asset but also memories of home, providing a sense of security. This explains why people develop a profound attachment to real estate. However, in the capitalist era, the concept of real estate has transformed. Housing has become a financial commodity, no longer offering a sense of home, but serving as a pure investment vehicle. Today, only a small fraction of buyers purchase homes to live in. Many acquire properties for investment, profiting from price differentials or using them as collateral for liquidity. Real estate has become largely virtualized, a financial asset. The core logic of financial assets is that higher prices yield greater returns. For instance, strong performance by real estate companies and rising property prices boost their stock values and market performance, generating higher profits for asset holders. However, this leads to low-income individuals being priced out of the housing market. The study notes that in the U.S., from 1984 to 2019, the wealth gap between white and black populations grew by 35% or roughly $31,500, with real estate accounting for over $29,500 of that gap. Without real estate appreciation, the wealth gap would have increased by only about 2%, yet this reflects a historical inevitability. Capitalism typically evolves from small-scale, workshop-based early capitalism to large-scale Fordist production, and ultimately to virtualized financial capitalism. From a long-term perspective, surging real estate prices mark the transition to financial capitalism. In China, the real estate boom began after the 2008 financial crisis, when traditional manufacturing and assembly industries collapsed. With profits drying up in traditional sectors, capital flowed into real estate, inflating property prices. Recognizing shifting economic trends, the Chinese government pivoted from supporting traditional industries to backing real estate. Thus, government and corporate policies followed economic signals, not arbitrary decisions. The real estate bubble resulted from the decline of traditional industries. In the U.S., the housing price index has risen steadily since the 1990s, coinciding with President Clinton's globalization push and the outsourcing of traditional industries. As the economy became virtualized, real estate became highly financialized, with prices peaking before 2008. After the subprime crisis, property prices crashed alongside other financial assets, but quantitative easing in 2009 spurred renewed growth in both real estate and stock markets. The US and China, as representative global economies, saw property price surges after their economies virtualized. Hong Kong, a long-standing financial hub, experienced similar financialization of real estate, turning it into a pure financial commodity. What is termed real estate dominance is, in essence, a manifestation of an economy entering the financial capitalism stage. The critical issue is not dominance, but the economic cycle and historical phase. Returning to the present, in 2025, real estate dominance in China and Hong Kong has vanished, replaced by a real estate crisis. What does this signify? It indicates that the Greater China region's economy has moved beyond the virtualized, financialized stage into a new phase, the disaster economy. Before this, we experienced the incremental economy and the stock economy. The incremental economy corresponded to the era of thriving traditional industries, when the economic pie could still grow, benefiting all. As growth slowed, we entered the stock economy, aligned with the era of real estate and financial dominance. Here, the pie could no longer expand, and the focus shifted to dividing it and speculating on asset prices. After 2020, we transitioned from the stock economy to the disaster economy, where even existing wealth has dwindled, and profits come from the sick, elderly, and deceased. In this era, the most promising sectors are pharmaceuticals, healthcare, eldercare, and funeral services. We are now in this disaster economy, and real estate has exited the stage. This explains the collapse of the once mighty real estate dominance. The root cause is straightforward: the era has changed. As I noted at the outset, falling property prices and failing developers are not positive developments. They signify a transition from the stock economy to the disaster economy, where we are extracting the last remnants of profit, retirement funds, or frankly, funds for waiting out the end. The eldercare industry is, in essence, a waiting-to-die industry, centered on an aging population nearing the end. Its workers accompany them, nothing more, with no grand purpose. Our economic cycle has reached its final and most troubling phase. Once this stage concludes, we are likely to witness profound, transformative changes, a complete reset. This process, I believe, will be nothing short of dramatic. Thanks for watching and joining us on this journey to unveil China's many layers. If you found this video insightful, please give it a thumbs up, share it with others, and hit that subscribe button to stay updated. See you in the next video.